That three-digit number, your credit score. It has a surprising amount of say in your financial life, doesn't it? If your score is sitting around the 600 mark, you're probably wondering, what doors does this open, and which ones might it firmly close? Today, we're going to peek behind that curtain. Here's something to think about. Around 27% of people with credit scores in the fair range, and yup, 600 falls right in there, are statistically more likely to run into serious trouble making loan payments down the line. Now, that single statistic? It's a big part of why lenders hit pause and look at much more than just your score when you apply for a loan or credit card. It's not just about a number. It's about how much risk they think they're taking on. So, what's the immediate thought when a lender sees a 600 credit score? Well, generally, scores from 580 to 669 are considered fair by the big scoring models like FICO. It's a bit below the U.S. average, which was around 715 in early 2024. This fair label means you're not automatically seen as a high-risk borrower, but you're definitely not in those good or excellent zones that get the red carpet treatment with the best terms. Lenders tend to see a 600 score as a sign of moderate risk. Some, especially the more traditional banks, might hesitate or even turn down applications in this range. Others, often known as subprime lenders, actually specialize in working with folks in this fair credit category. But this usually comes with a catch. Typically higher interest rates and more fees. It's how they try to balance out that higher perceived chance of delinquency. This is where things get really interesting. That 600 score is just the starting line. It's far from the only thing lenders care about. They're trying to piece together a full picture of how reliable you are with money. First off, they'll dig into the details of your credit history. They want to understand why your score is 600. Are there late payments? If so, how many and how recent were they? Collection accounts? Those are pretty big red flags. These details give context to that three-digit number. Next up is your debt-to-income ratio, DTI. This is a simple comparison of your total monthly debt payments to your gross monthly income. If your DTI is high, even with a fair score, it can suggest you might be stretched thin and could struggle with new debt. For example, with mortgages, lenders often want to see your total debts, including the potential new loan, stay under a certain percentage of your pre-tax income, frequently around 43-45%. Your income stability and employment history are also pretty crucial. Lenders really like to see a steady, reliable income. Having a stable job, ideally for 2 years or more with the same employer, points to financial stability. Hopping between jobs frequently or having unpredictable income can raise some eyebrows. The type of loan and how much you're asking for also plays a part. A lender will assess risk differently for a small personal loan versus a hefty mortgage. They'll also consider any collateral you might offer. This applies to secured loans like car loans or mortgages, and the size of your down payment. A bigger down payment naturally lowers the lender's risk. And finally, some lenders also take a look at your assets and cash flow. Having some savings or investments can show you manage money well and might improve your chances of approval, even if your score isn't stellar. With a 600 credit score, getting approved isn't a sure thing, but it's often doable, especially with certain kinds of loans and lenders. Personal loans. You can probably get a personal loan, but brace yourself for higher interest rates. Think somewhere between 18% and 35% for unsecured loans. The loan amounts might also be on the smaller side, and the repayment periods could be shorter. You'll likely have more luck with alternative or subprime lenders here. Auto loans. Getting a car loan is achievable, particularly if you look at subprime lenders, credit unions, or some online lenders. Just to give you an idea, Experian data from Q1 2025 showed that borrowers in the subprime category, scores from 501-600, faced average new car loan rates around 13.22% and used car rates around 18.99%. You might also find you need a larger down payment. Mortgages. Qualifying for a mortgage with a 600 score is definitely more challenging but not impossible, especially if you're looking at government-backed loans like FHA loans. FHA guidelines can accept scores as low as 580 with a 3.5% down payment, though individual lenders can, and often do, have stricter requirements. Be prepared for higher interest rates and mortgage insurance costs, though. For conventional loans, you'll typically need a score of at least 620. Credit cards. You'll likely qualify for credit cards aimed at people with fair credit or those looking to rebuild their credit. These could be secured credit cards, where you put down a security deposit, or unsecured cards that come with lower credit limits, higher annual percentage rates, APRs, and maybe even annual fees. You're probably not going to get the green light for those fancy premium rewards cards. The biggest way a 600 credit score will hit you is in the cost of borrowing. Lenders make up for that higher perceived risk by charging higher interest rates. What does that mean for you? Your monthly payments will be higher, and you'll end up paying a lot more in interest over the life of the loan. For instance, on a $30,000 car loan over 60 months, someone with poor credit could easily pay over $11,000 more in interest than someone with excellent credit. Ouch. You might also run into lower loan amounts or credit limits, shorter repayment terms, higher fees, like origination fees on personal loans or annual fees on credit cards, bigger down payment requirements for car loans and mortgages, the need for a co-signer in some situations. When it comes down to it, a lender's decision is all about weighing risk against reward. They're in the business of lending money to make a profit, but they also need to keep losses to a minimum from borrowers who can't pay them back. A 600 score tells them there's been some history of financial bumps in the road, or perhaps a limited credit track record. All those hidden criteria we talked about, they're designed to dig deeper and figure out if those past issues are likely to happen again. They're looking for what they call compensating factors, things like a stable, high income, a large down payment, or a low DTI, that can help offset the risks suggested by that fair credit score. If the good stuff outweighs the perceived risk of the 600 score, they might approve the loan, but likely with less friendly terms than they'd offer someone with a higher score. If the risk still seems too high for their comfort, they'll have to say no to the application. Having a 600 credit score puts you in the fair credit zone. While it doesn't mean you're completely locked out of borrowing, it does mean lenders will take a much closer look at your application. They're peering beyond that single number to assess your overall financial health, your income, your debts, and the specific details of your credit history. You can still find approvals for personal loans, auto loans, certain types of mortgages, and credit cards. Just be ready for potentially higher interest rates, smaller borrowing amounts, and stricter conditions. The main thing to remember is that while a 600 score comes with its challenges, understanding what lenders are really thinking can help you better prepare your application. More importantly, it can empower you to take steps to improve your score and build a stronger financial future.